Hello, everyone, and welcome to Financial Market Insights for Traders. I'm your host, Sophia. Today, we're exploring a portfolio management concept that has gained significant attention among institutional investors, hedge funds, pension funds, and increasingly, retail investors. It's called risk parity. If you've ever wondered whether there's a better way to build a portfolio than simply deciding how much money to put into stocks and bonds, this episode is for you. Let's start with a simple question. When you build an investment portfolio, do you focus on where your money is allocated, or do you focus on where your risk is allocated? Most investors think in terms of capital allocation. For example, a traditional portfolio might consist of 60% stocks and 40% bonds. On the surface, that appears diversified. However, when you examine the actual risk within that portfolio, you often discover something surprising. Stocks may account for only 60% of invested capital, but they can contribute as much as 85 to 95% of the portfolio's overall volatility. In other words, while the portfolio appears balanced by capital, it may be heavily concentrated by risk. This is exactly the problem that risk parity seeks to address. Risk parity is an investment strategy that allocates assets according to their contribution to portfolio risk, rather than simply allocating money across different investments. Instead of asking, how much money should I invest in each asset? Risk parity asks, how much risk should each asset contribute to the portfolio? That shift in thinking creates a completely different approach to portfolio construction. A useful analogy is to imagine a group of people carrying a heavy object. In a traditional portfolio, one or two people may be carrying most of the weight, while everyone else contributes very little. If one person struggles, the entire group is affected. Risk parity attempts to distribute the weight more evenly across the group. Applied to investing, that means balancing risk across multiple asset classes rather than allowing stocks to dominate portfolio performance and volatility. A typical risk parity portfolio may include stocks, government bonds, corporate bonds, commodities, real estate-related investments, inflation-linked securities, and cash equivalents. The goal isn't necessarily to maximize returns in every market environment. Instead, the objective is to create a portfolio that can remain resilient across a wide range of economic conditions. And that's why many investors view risk parity as a different approach to allocation. Traditional asset allocation often focuses primarily on expected returns. Risk parity focuses first on risk management. The philosophy behind this approach is that accurately predicting future market conditions is extremely difficult. Rather than attempting to forecast which asset class will outperform next year, risk parity aims to prepare for multiple possible outcomes. Consider how different assets respond to different economic environments. During periods of economic growth, stocks often perform well as company earnings rise and consumer spending remains strong. During recessions or periods of economic uncertainty, government bonds may provide stability and act as a defensive asset. In inflationary environments, commodities and inflation-linked investments can help preserve purchasing power. During deflationary periods, high-quality bonds may perform relatively well as interest rates decline. By maintaining exposure to assets that perform differently across these scenarios, a risk parity portfolio seeks to improve diversification and reduce dependence on any single economic outcome. The strategy gained significant popularity among institutional investors and was influenced by investment philosophies developed by Ray Dalio and Bridgewater Associates. Since then, risk parity concepts have been adopted by pension funds, endowments, asset managers, and individual investors around the world. So, what are the potential advantages for retail investors? First, enhanced diversification. Risk parity goes beyond simply owning multiple assets and focuses on balancing actual risk exposure. Second, lower portfolio volatility. Because risk is spread more evenly, portfolios may experience smoother performance over time. Third, reduced drawdowns. While losses cannot be eliminated, the severity of portfolio declines may be reduced during challenging market environments. Fourth, greater consistency. Investors are less reliant on the performance of a single asset class. And finally, improved risk awareness. Investors begin thinking about risk contribution rather than just allocation percentages, which often leads to more informed decision making. Of course, risk parity isn't perfect. One drawback is complexity. Measuring volatility, correlations, and risk contributions requires a deeper understanding of portfolio construction. Another challenge is that risk parity portfolios may underperform during strong equity bull markets because they typically allocate less risk to stocks than traditional portfolios. In addition, many risk parity strategies rely heavily on bonds, which can face headwinds when interest rates are rising. Finally, maintaining a risk parity portfolio often requires ongoing monitoring and periodic rebalancing as market conditions change. For retail investors interested in applying risk parity principles, the process can start with a few simple steps. Diversify beyond equities. Consider including bonds, commodities, and real assets within your portfolio. Pay attention to risk contribution rather than focusing exclusively on percentage allocations. Rebalance periodically to maintain your intended risk profile. And most importantly, think long term. Risk parity is designed as a portfolio management framework, not a short term trading strategy. Before we wrap up, if you're looking for a cutting edge and user friendly trading platform app to help you monitor markets, analyze opportunities, and manage investments more effectively, visit crystalbellmarkets.com/platform. And if you'd like to continue learning about trading, investing, macroeconomics, risk management, and financial markets, be sure to check out the Crystal Ball Markets podcast at rss.com/podcast/Crystal Bell Markets. That's all for today's episode of Financial Market Insights for Traders. I'm Sophia, and remember, successful investing isn't just about maximizing returns. It's also about managing risk intelligently. Risk parity offers a framework that helps investors think differently about diversification and build potentially more resilient portfolios for the future. Thanks for listening, and I'll see you in the next episode.